Hi, good morning. My name is Fahreza. Welcome to Evening News. Today, we're going to talk about stock market in Indonesia. The topic is about Mr. Peter Lynch, which is book One Up on Wall Street. Here is some review about his book.
The book One Up on Wall Street, How to Use What You Already Know to Make Money In by Peter Lynch is a very helpful book for those who want to gain some basic knowledge about how stocks work in the financial market and how to select the best portfolio of securities. Peter Lynch shared his experiences and told us how he felt or how he dealt with losses and success when investing. We personally like these books, and he made this seemingly difficult concept become easier to digest. One Up on the Wall Street is a perfect guide for an aspiring investor who wishes to learn stock investing from a proven genius. It is a complete package that tells an investor about how they should approach the market, how to buy, when to buy, how much to buy, and finally, when to sell. It is great that Peter Lynch decided to write his investing philosophy as a book, and millions of investors around the world, including us, could benefit from his experiences.
Today, and you could be out of that, you could be in the automobile business tomorrow. And that ability to enter and exit and get paid back for your investment in those shares creates a great market for the initial investment. People are more willing to put that money up if they know that sometime in the future they'll be able to sell out their interest and go on to the next best thing.
40% of American families own stock in U.S. companies either directly or through mutual funds and pension plans. The exchange lets people know how these companies are doing by allowing a free market to place a value on their stock.
Well, I like to say that a stock market is a market in information. I mean, it uses information from outside to evaluate companies, but then the process of the stock market creates new information by putting a price on things that everybody in the country can read.
Now we're already connected with the reporter, Mrs. Andin. Mrs. Andin was in Mr. Peter Lynch book review Avenue in Jakarta. Mr. Peter Lynch has already in Jakarta for 1 week for his book review. We will connect it to Miss Andin. Mrs. Andin, can you hear me?
Yeah, Reza, I can hear you.
Can you tell me about what happened there in the Mr. Peter Lynch book review?
Yes, I am reporting now from Peter Lynch Meet and Greet book review. Peter Lynch already described his book review about One Up on Wall Street that invite a small guest, that the lucky one who can attend the book review.
So, is there any question?
Peter, I want to ask a question to you. Actually I have 3 questions, but in 2 questions, but there will be 3 questions actually. First is how to minimize risk and to maximize the profit, and why? And the second question is, when is the best time to buy stock? I think that is my question. The first one is, actually there is 2 questions, and the second one is, when is the best time to buy the stock? Thank you, Pak Peter.
Thank you, Pak Ali, for your question. So, ladies and gentlemen, I have prepared a video that can explain the 6 different nature of a company. From this video, you can choose which company that you more prefer, because every company different aspect, especially in the risk and also a gain. So, please watch this video.
One of 6 general categories. They help you to look at the companies from the right perspective, as each of the 6 categories has certain characteristics you have to be aware of. The leading characteristic within the first 3 categories is the growth of earnings. First, the slow growers. These are usually made up of large and aging companies that are expected to grow slightly faster than the gross national product. You can think of McDonald's as an example. Stalwarts are companies such as Coca-Cola, Procter & Gamble, Johnson & Johnson and Berkshire Hathaway. These multi-billion-dollar giants are not exactly age-hill climbers, but still they are faster than slow growers. When you are invested in Stalwarts, you can expect more or less 6 to 10% annual growth in earnings. Lynch advises everyone to have some Stalwarts in the portfolio as they offer pretty good protection during recessions and hard times. The fast growers are small, aggressive new enterprises that grow at 20 to 25% a year. Although there's higher risk if you choose wisely, this is the land of the 10 to 40 baggers and even 200 baggers. These are Lynch's favorite investments. In hindsight, examples include Zara and Disney. They don't have to be in a growth industry, but what they need is a winning repeatable formula like Starbucks had when it started out. Something that has proven itself in more than one location and still has room to grow. The second group is made up of special situations. Cyclicals are companies whose sales and profits rise and fall regularly, in an almost predictable fashion. In general, they follow the overall pattern of the economy. Examples would be in the automotive and steel industry. Timing is everything in cyclicals. You have to be able to detect the early signs that the business is falling off or picking up. And therefore, it is important that you have an edge in the industry. Turnarounds are companies that are depressed and often close to or even in bankruptcy. You can find great opportunities among this group as they can make up lost ground very quickly. They are a great way to diversify your portfolio as their ups and downs do not follow the direction of the general market. An asset play is any company that is sitting on something valuable that you know about but the Wall Street crowd has overlooked. The asset play is where the local edge can be used to the greatest advantage, because often the undervalued assets are made up of real estate.
So to invest in a company, we need to know the nature of the company. There are 6 categories that I already explained it before. And how to invest it is better in the short term. We cannot achieve it within 3 years. So we need to think about the long term. And the fundamental and also the value become what we want to know mostly, and we want to know from the internal of the company. Those what I recommended to the beginner, also in the advanced player, that what I discuss and what I write on this book. So let me recap for a while that you asked about the how to minimize risk and how to maximize the profit. If I'm not wrong about what you're asking about your question. So it is best to own the many stock as possible. So more than 3 or more than 3 and more than 10 is quite different in the probability. So how much stock that you have, of course, it increase the how much gain or how much you earn for the stock. And it is wise also to have many stock as possible, because you have a flexibility to turn from another stock to other stock that you have. Another benefit that you have many stock, as you can see, there are 6 different type of company. From the slow growers, if the slow growers, you have the low gain and also the low risk. But if you're getting better, like Stalwart, you have low risk, but you have the moderate gain. And if you fast movers or the turnaround company, then you have the high risk, but also you have the high gain. It is again depend on what your personality. And what about the asset play? This is more safer, I think. This is you have the low risk and also the high gain. That's what my advice to you guys. And next question is about what is the best time to buy the stock, if I'm not wrong. So there is no one, including me, that I can predict about the market. But maybe, of course, there are signal about signal. For example, if in the end of the year October until December. You can buy some certain stock, or if there is any downfall or rise in the some company that you observe, that is a good signal when is the best time to buy the stock. Then I put in the conclusion before, it is better to have a long period of stock. I didn't recommend to buy future or to buy an option because it's diverted the risk to the investor, and it is all the risk can be transferred to the investor, and it is not good enough, and it is better, or I recommend if you can buy a long-term period of investment. Make sure that everyone notice and note about this. Don't invest your money in a company or in a stock that you will use in the next 3 years. Allocate the investment in the long term of time and long term of investment. This is what my final wisdom for you guys, and hopefully that concludes our conversation. If there is any question, I would like to know more. And thank you for the moderator.
Let's interview some of the guests. Hello guys. I'm sorry to disturbing you all. I'm Andin from Group3 News.
Azhar.
Okay.
Ari.
Andin.
Investment.
Oh. So may I interrupt both of you?
No problem.
Okay. Okay.
If you want to discuss it.
Okay. Thank you. So guys,
Okay.
actually what are you doing now?
Actually, I'm a newbie. When I attend and hear about Peter Lynch lecture about this book, One Up on Wall Street, I discussed. Pak Azhar also attended that lectures. We discussed about how to implement it in the real stock market. So Pak Azhar is expertise in here. He's a practitioner in the stock market. So yeah, we discuss about it.
Oh, so what do you think about the book review event?
Yeah, it's a very interesting event. Yeah, actually, I'm a newbie. Like I said before, it's really give me good knowledge about market on stock, and yeah, it's really good event. And I discussed it with Pak Azhar. Actually, he's a practitioner, but he still get the benefit from this event.
Okay, now I'm gonna ask Pak Azhar, the practitioner in stock, how to invest in stock. So, Pak Azhar,
Yes.
Before investor decide to invest in stock, what should investor need to prepare?
Okay, before decided invest in some company, investor need to prepare two action. First is pick the right stock and the right price. It is mean that pick the right stock at the right time and the right price, of course. And then not for short-term investor. As you mentioned, you are an investor, just keep the stock as long as you can keep that stock. And then you have to make your own research, so you know the company. After that, you can choose the company because you know at that time the company is undervalue or overvalue. And my suggestion for you as a new investor, maybe just pick the blue chip stock.
Why blue chip?
Actually, blue chip can still fall down even the market is crash. The blue chip not go deep faster.
Okay. In your opinion, what kind of personal qualities that investor should have?
As an investor, you have to be patient. It means that you have to waiting the moment that you can choose the stock really cheap, and then you have to be tolerance of the deeper stock. You have to choose maybe 5% or 2%, when the bottom line is connected, you have to cut. And then you need to do independent research. So you have to avoid about some rumors, some news that can influence your decision. And finally, it is important to you to make a decision whether you have a lack of information. That's the point.
Okay, Pak Azhar, thank you so much for your time and for your information.
Nice to see you.
Okay, thank you Pak Ari for your time. Okay. Okay, Ja, back to you in the studio. Good morning. Bye.
Thank you, Andin, for your report. It's so delightful there. I wish I could be there. And now, we already connected with our investor in America, Mr. Cahyo. Hello, Mr. Cahyo. Can you hear me?
Yes, Pak. I can hear you.
What do you think about Peter Lynch's book, One Up on Wall Street?
Okay, in my opinion, Peter Lynch is a good writer and a great investor and a genius one. In this book, One Up on Wall Street, Peter Lynch talk about how to preparing to invest. Peter Lynch said that before we invest, please note that if you don't have a house, please buy a house first. The second is use only extra money to invest. And the principle is you don't have to be genius to succeed at investing. When we found a stock that looks really good according to the numbers, don't invest just because of the numbers, but make sure you can describe why this business is a good business and why you buy this stock. My favorite tip in this book is when I heard that my stock is hot, I started to think about selling my stock. For me, the hot stock are a bad idea, but the boring stock are a good idea. Finally, Peter Lynch's strategy in this book is great. I got a huge gain by doing what Peter Lynch said in this book. I think this is my opinion, Pak, about Peter Lynch's One Up on Wall Street. Thank you.
Thank you, Mr. Cahyo, for your comment. And then that's all our report. Thank you for your attention. Me Fahreza from IPNI News. Thank you and have a nice day.